In this episode of On the Tape, I welcome the co-founder and co-manager of the Bitcoin Opportunity Fund, James Lavish, to the pod. James and I share very similar views on the macro, including the unsustainable debt and deficit levels, the role of central banks, and the vulnerability of fiat currencies. James talks about his evolution from Yale hockey player to Wall Street trader to Bitcoin Maxi, and how he sees policy and regulation playing a role in the crypto world. Having launched his fund in 2022 into the teeth of both the Celsius and FTX collapses, he persevered and was able to take advantage of that volatility and succeeded in allocating his first fund in both private and public investments, and is now raising Fund 2. James shares his thoughts on Michael Saylor and his, quote, strategy, pun intended. James also discusses the U.S. Treasury strategy to create demand for bonds via changes to the SLR for banks, as well as the advent of stablecoins and the recent bills like the Genius Act, which passed recently in D.C., and we dig into Tether a little bit as well. But before we get to James, I wanted to share some of my thoughts about the current state of the economy and markets. Whether you're a professional money manager or just an investor in the markets, it's your job to trade the policies being implemented, such as tariffs, and figure out how they impact the market and various asset prices. While it might be difficult to ignore the political noise surrounding some of these policies, you have to trade the game currently being played, even when it feels like the rules are changing between plays. That being said, there is only so much uncertainty the markets can handle, and we see this play out with intermittent spikes in volatility and sell-offs that can be extreme at times, but force people to re-underwrite the current investing climate. What concerns me most right now is not valuation, as much as entering a period when we begin to question not just the reliability of economic data, but the potential loss of independence and credibility at various agencies, including the Federal Reserve, the BLS, and I am sure what's coming next, which is the BEA, the Bureau of Economic Analysis, which produces what? The GDP and the ever-important inflation gauge, the PCE. Ever since the GFC in 2008, the markets and investors have become more dependent on both monetary and physical policies as a central part of their investment thesis, and the reliance and reaction of policymakers has been as important as the underlying fundamentals of individual companies in such a financialized driven economy. While government data is important to acknowledge and used as an input as part of the investment process, it has always been inexact and, in my opinion, overtraded when released. This is why it is more important than ever to listen to what individual companies are doing and saying, and how they are adjusting in real time to changes in policy and the economy, and try and refrain from overtrading and overanalyzing government data. So as we enter the final stretch of second quarter earnings season, I recommend listening to company conference calls, reading transcripts and 10-Qs as a better source of information, and real-time outlooks that already incorporate economic conditions into company forecasts. Whether or not the economy slows as we enter a period of either stagflation, deflation, recession, or just moderate growth, there are always opportunities to invest across all asset classes. And I will end with this. Never in my career has the phrase, the stock market is not the economy and the economy is not the stock market, been more accurate than right now. So with that stream of consciousness out of the way, I hope you enjoy my conversation with James Lavish. In the spirit of broadening my horizons, it's a real pleasure to welcome James Lavish to the pod. James, welcome to the pod.
Well, it's good to be here, Danny, and I appreciate talking to you.
So other than the fact that you attended an Ivy League school, you played college-level hockey, you look like Johnny Lawrence from the original Karate Kid. We actually share similar views about macro global economy and so forth. So why don't we start there before we go into the fund that you're running? Give us your macro views, because I think that sets up everything.
Yeah, I mean, we've been talking about this for a while. I've been talking about it for a while. My macro view really just centers around the debt spiral that we're in. We have created a situation here where we borrow so much and we spend so much every single year in the U.S. government, and it's not just the U.S. government; it's all developed nations that issue debt in their own currency. The problem is we've gotten into a situation where we can't keep up with the payments. And even though we've got, the new Doge Commission, and they came in and they cut out some fat and some illicit activity, there's just too much. There's just too much spending at the very top end, which is the structural spending. It's the entitlement programs, the mandatory programs that we have. And so, my entire macro thesis kind of centers around this spending, this need for leverage in the system, the continuous need for leverage and borrowing all that future productivity into the now, and the need to expand liquidity to meet that. And so that's the kind of the spot that we're in, this great global fiat experiment.
So you and I share those same views. I use gold to express it, use Bitcoin, although I know you like gold. So let's talk about evolution of how you kind of got here, because I looked up your history working on Wall Street, trading ADRs down on the floor, looking at Bitcoin for the first time kind of pre-COVID, then during COVID, things like that. And, you and I were kind of running parallel paths in the regard of, can I look at Bitcoin? You and I both knew very smart people that were doing it. So there had to be something to it. So what was the final kind of push that you got to make you I would call it a Bitcoin maxi, but
Yeah.
how did you get there?
Well, again, being just like you said, just knowing that this just can't continue forever, and you've got to protect yourself somehow. And I've always liked gold. I own gold, and when I left my hedge fund and I was trying to figure out what to do, Danny, my son actually, and if we go back a number of years, I'd heard about Bitcoin. I had been told about it. My wife told me about it. She had heard a podcast with Tim Ferriss or something, and she can't remember who it was, but it was likely Peter Thiel or something that we were talking about Bitcoin, and and she said we should check into this thing. And then I did what you do normally as a typical Wall Street guy. You go and ask the experts. You and I know how well that pans out sometimes. And I asked the experts and the technology analysts and portfolio managers and different analysts on the street, because new technology, and every single one of them said, stay away from it. It's a Ponzi scheme. There's no underlying value. It's going to go to zero. You lose all your money. And so I did, and that was when Bitcoin was hovering around $3,000 or $4,000. Flash forward to the pandemic, and now you've got this massive money print. The Fed expanded their balance sheet exponentially, and people were trying to figure out where to find value and where to hold value. And gold obviously is one of the places. They were using stocks, real estate. So the question was, at the same time that was happening, was what was I going to do leaving my hedge fund? And the reason was geographically. I moved across the country to be with my wife, where we had been living in two cities for years. And so we just decided we said, my kids are going off to college. We're going to, go to one place. And it ended up leaving my hedge fund. And so I wasn't sure what I was going to do. And my son was a smart kid. He's in Cornell at the time, and he's surrounded by all these guys who are trading this crypto stuff. And he's like, Dad, there's something here. You should really check into it. So I did. And I bought all the usual suspects, the Ethereum, Cardanos, and the Solanas of the world, and some Bitcoin. And then I started doing some serious research and going down that rabbit hole, Danny, and trying to figure out, well, which one has I'm not just looking for returns. I'm looking for actual value here, and which one is going to give me what I'm looking for. And the further I went into that rabbit hole of Bitcoin, the more I understood how it's singular. There's nothing else like it in the world. No other cryptocurrency is like it, as you and I understand. But what got me over that hump? Well, it was the concept that Jeff Booth, who's a super maxi, who talks about this quite a bit. It was the understanding that we're going down this path of just the need to continuously debase our currency in order to meet those debt obligations. And so, to simplify it for your listeners, what do I mean by that? I mean, as we pile on more and more and more debt, and we are borrowing more and more money, we have to pay back that debt. It begets more borrowing, right? So you've got those payments that we talked about, the entitlement programs, Social Security, Medicare, Medicaid. You have to pay for your military expenses. Those are not going down. Those are continuing to expand. Then you've got your interest payments and your debt. And as you borrow more, you're going to have to borrow more debt. And so how do they deal with this? They deal with it by expanding the money supply. They create a situation where you've got GDP expands nominally in order to pay down past debt with cheaper future dollars. It's a pretty simple concept, but that's structurally what we've been doing for many years here, arguably since 1971. And so why does it matter? Well, it matters because suddenly you have this asset that's deflationary in that it can't be expanded, it can't be manipulated like fiat. And so now you've got you've got kind of two forces that are working against each other. Okay, you've got the need for the expansion of the money supply and for expanding GDP nominally to pay down that debt, to debase that dollar. At the same time that you've got this force of technology, Moore's law, the technology where it's creating more and more the productivity and more abundance for less effort, right? So it's deflationary. So you've got this deflationary force versus an inflationary force, and they're colliding because this has to expand that much more to make up for the debasement of the deflation of goods and services, because technology is deflationary. And so once I understood that and realized there's really no way out of this, there's no way out except for some sort of hyperinflationary event where we reset everything, and it's an ugly future, until I heard about Bitcoin and the ultimate digital gold, where you can actually have something to store your value, that energy that you put out, instead of having to spend it to avoid the inflation, and instead of having to risk it in stocks and bonds or real estate or whatever, or bonds are they're actually just giving you a negative real return. You have something that you can base your currency on and avoid that catastrophic event in the future. And that's my hope. That's ultimately where I think we're going.
My son, who was in high school at the time, started to buy it. I made him sell it. Opened up a Coinbase account in 2017, bought a little, sold, had it for like a week, couldn't take it, had Ethereum, Bitcoin, whatever. So yes, I didn't even dip my toe in. I dipped a fingernail in there. But anyway, so help me with this. Okay. So when I started looking at these assets in general, whether it's Ethereum, Bitcoin, I think of them as kind of what market value, right? So as I'm looking at it like it's a market cap. So if I see Bitcoin here, let's say at 2.2 trillion, which I know you're going to tell me is the wrong way to look at it, but you just mentioned the use case so far. Now tell me if I'm wrong. There were supposed to be other use cases by now. I could be way off on that. It's a store of value. So what's the valuation that makes sense? I know there's a finite amount, you can't issue more. It's 2.2 trillion as we sit here. How do I think about its value just accretes over time? How do you measure that, I guess, would be my question. I'm sure I'll get crushed for even asking that question from the
No.
Maxis out there, but just curious.
No, that's a good question. It's a normal question. What you should be asking, like, what is the value of it? Well, there's a couple of different ways to look at it. Okay, so the first thing is, does this thing even have value? Well, what's the value of the U.S. dollar? The U.S. dollar has confidence in it. People say it's backed by the U.S. military or whatever, the military industrial complex. Look, the U.S. dollar has value because you and I believe that if I give you $1, then you're going to be able to go spend it somewhere else, that somebody else will take it. It's just that confidence in that currency. So what gives Bitcoin that confidence? Well, it's the network effect. Okay, so what do I mean by that? I mean that you and I can exchange Bitcoin and know that whatever I give you is going to be worth it, the certain amount of that total amount of Bitcoin that's ever going to be out there. So it's a finite amount. It's governed by a mathematical equation that there's never going to be more than 21 million Bitcoin ever created. So, well, okay, that's great, but how do I know that that's going to continue? That won't get changed. What the network effect, right? So why is that important? Well, so we know that if you and I exchange Bitcoin, then you can have the confidence that whatever I give you, you're going to be able to turn around and spend that, because it's a certain amount of the total Bitcoin that's ever going to be created. And Bitcoin solved what is called the Byzantine generals. It's a Byzantine generals problem, where generals didn't know if their lieutenants around them, they couldn't communicate with them. They didn't know if they were going to try to overthrow them or do what they had commanded them to do. There was no way to tell if you're thinking about the lieutenants out in the field. Like maybe they could get together and usurp them. Well, Bitcoin solves that problem because it's a ledger that's public, that is governed by all of these nodes that have the same exact incentive, and that's to keep the Bitcoin network safe. And so, but what's so important about that is that knowing the confidence that it's all governed by math, it's governed by these nodes that are across the world. It's completely decentralized. There's no other currency, cryptocurrency, that's decentralized, right? So there's nothing that's like that. It doesn't have a CEO. It doesn't have someone who's in command of it. Even if someone owns millions of coins, it doesn't matter. They can't change the protocol. The protocol is the protocol, and it's governed by the nodes, and the nodes are all pulling in the same direction, because if they don't, it's suicide. If a node puts forth a ledger that doesn't match all the other ledgers, they just simply get kicked off the network. How is that secured? Well, it's secured by energy, right? So the energy that Bitcoin network runs on is the equivalent of about 80 terawatt hours of energy. For those people who are not engineers, that's the equivalent of about 21 full-scale nuclear reactors running 24/7. So that makes it nation state resistant. It cannot be changed. It cannot be attacked. It cannot be overturned. And so that confidence is what's allowing this network to grow. And as more and more people use it and use it and use it, that confidence grows more and more. Okay, so that's its use case, and that's how that confidence grows. So how big can it get? Well, if you know that, then you know that this is ultimately a better form of gold. It's easily transferable. I can move and transportable. I can move $1 billion of gold. I would have to hire armored cars and guards, and then put it on trucks and boats. You probably couldn't even move it on planes. And it would take a very long time. I could move $1 billion of Bitcoin before the end of this podcast. It would take about 10 to 15 minutes. It's done. It moves for a fraction of the cost. So it's super easy to transport. It's super easy to transfer. It's also immutable. And that means that if I send $1 billion to you, I can't send the same $1 billion of Bitcoin to anybody else. That's why that blockchain, which is a time chain, prevents that. And the nodes all pull in the same direction. If a node tries to put forth a ledger that has me double spend, they'll get kicked off the network. It just doesn't work. So, and it's also, there's only so many Bitcoin that'll ever be created. It's scarce, so it's even more scarce than gold. And it can't just be taken from me at the border. So if, say and I do have friends who have left Egypt, who've left Venezuela and other hostile places, that they wanted to get out before the collapse of their currency or their economy. And what they do, they put their money in Bitcoin, walked across the border, left, and wherever they went, that Bitcoin was waiting for them. They didn't even have to take it. They just knew it was there waiting for them. So you can't do that with gold or US dollars. It gets seized at the border. So once you understand that, and you understand that it's a better form of gold, and that it's what the future wants. Kids don't want to lug around gold coins and gold bars. They would rather have the Bitcoin right on their phone. It's easy for them. They get it. They understand it. This is the future. So now what's the use case for it if it's just digital gold, which I think it will go beyond that in the future. But right now, let's just talk about it being the best store of value out there. What's the use case of it? What's the addressable market? Well, the addressable market would be all the investable assets in the universe, right? So you've got that. There's a chart that Jesse Myers puts out. He's an analyst that does. He analyzes the total investable assets of the universe in the world. And so right now there's about $130 trillion of money, cash. There's about $320 trillion of bonds, $370 trillion of real estate. You can see the equities and arts and collectibles, gold, and then Bitcoin's down here. It's $2 trillion. But the total investable assets about $1 quadrillion. And so this is the use case. This is what happens Right now, Bitcoin has been really taking market share away from equities primarily and gold. Some people understand it as the best form of store of value. Some people think it's a speculative risk asset. So it's been kind of wavering between those. Um, and so as Bitcoin continues to grow, and as people understand it better, and this is the big hurdle, Danny, is the understanding of it, and understanding everything I just talked about, truly doing the research and understanding it, and having confidence in it. Well, then what happens next? Well, it starts to draw from real estate because it becomes a better store of value. It pulls a lot from gold, meaning that instead of gold going from 20 trillion to 50 trillion, well, Bitcoin will be about the same size as gold along that way. So in real estate, it's a better, it's a much better store of value than real estate in ways, because you don't have the headache of, first of all, maintenance and the fees, to oversight fees and management company fees, and dealing with tenants, and then of course taxes and all that. So and then it's illiquid. Whereas Bitcoin, like I said, I can move $1 billion in a matter of minutes. Think about how long it would take to do that in real estate. That's the next real big move from out of real estate. And then as people understand, and we get into this situation that exacerbates, and we start issuing not just 2 or 3 trillion extra dollars a year in debt, but 5 or 10 trillion, and you really get into a problem of debasement. Well, people are going to move out of bonds as they realize that this is just a negative real yield, and it's just killing portfolios. It's absolutely decimating. If you have mostly bonds, your purchasing power has gone down dramatically in the last 5 years. And so as people understand that, then you're going to start getting reallocation out of not just stock portfolios, not just your store value gold and flight to safety, not just real estate and REITs, but then also bond portfolios. And so what's the use case for Bitcoin? Well, I mean, how big do you think it can get in here? The reality is that gold's been around as a store of value for thousands of years, and it's only $22 trillion. Bitcoin's been around for 15 years, and it's already at 2 trillion. So its use case is growing. People are understanding it better. And as that understanding grows, it's going to start dipping into those other buckets.
So the name of that slide should be, how do you value a revolution? That's great. For people up there who can't see, you mentioned, so 135 trillion right now in equity value that's out there. So I realize it's a very small fraction of equities that are out there, but you look at the ETFs which have come on, you look at something like Strategy, formerly known as MicroStrategy. Why would you ever own MicroStrategy at a premium to the underlying value? I know it's a levered vehicle, it's a levered way to play it. I'm curious to get your thoughts here. And does it make you nervous that names like that, which again, I'm sure you would agree would be a buying opportunity if Bitcoin were to drop as a result of, quote, I'm not saying margin calls, but you and I both know you have converts out there. People can do the math. They'll figure out, oh, they're going to owe this on that. I'm using that as an example. I'm not saying it's going to happen, but how do you reconcile that? Because there is a portion of equities which are already getting a bid, some of that 135 trillion, as it relates to crypto and Bitcoin in general. So it is a little bit already in there, correct?
Yeah. I mean, look, what are we seeing in these Bitcoin treasury companies? Well, Michael Saylor was early on this. I know Michael. I've talked to him at length about these things, and he's an extremely smart guy. What he saw was the ability he was basically the first major company to see the ability to arbitrage the fiat capital markets, the US dollars in this case, versus the Bitcoin opportunity. And so what he found was, as he was adding Bitcoin to his balance sheet, to his treasury, the more Bitcoin that he added to his balance sheet, the more his stock started acting like Bitcoin. It started becoming, more of a proxy of Bitcoin. And so it became more volatile. And so that volatility in the stock ended up, at first people started getting nervous and worrying about it. They're looking at the price like, oh, this is crazy. This is not good. And he saw an opportunity. He thought, I can monetize this. Well, how can you monetize this? Well, as we know, working in hedge funds, there's something called a convertible bond. And those convertible bonds give you the ability to convert a bond into stock at a given price, at a strike price in the future. Well, the more volatile the stock is, the more likely it will be to hit that stock price, that conversion price. So when he started out early, he was issuing converts, and he was attaching an interest rate, a coupon to that convert. But then he realized that the demand for it was so great that he could turn around, issue these converts, borrow money basically for free with 0% interest and just an attractive strike price on those bonds. And so he was monetizing that volatility, getting dollars for it, turning around and buying Bitcoin. And then what happened? Well, the price went up because it would then go up in value according to Bitcoin, and because he was trading at the time about a 2 MNAV, which is a multiple to the underlying NAV of Bitcoin. Every single time he went out and did this and bought more Bitcoin, the stock price would go up by about 2x of the dollars he borrowed to go buy Bitcoin, the dollars he bought Bitcoin with, right? So it was an arbitrage there, and he continued to do that. He later figured out that, oh, the convertible bond traders are sitting on my stock because they're shorting it using delta hedging in order to short that stock, and they can trade around it, and they can make money along the way on that volatility as it goes up and down. If it goes up, they short more. If it comes in, they cover, and that's that optimum hedge, the delta hedge that they're keying in on. And you realize, well, I want to kind of get out of the shorting of my stock game, and he started issuing preferreds. And so now you've got these preferreds, some of them convert, some of them don't, that pay an interest rate. And so now he's just borrowing money at a certain rate and turning around and buying Bitcoin with it. And so other companies have caught on, and they realize that there's an opportunity here to capitalize on, to buy Bitcoin by arbitraging those capital markets, borrowing fiat dollars to do that.
Was very smart to issue equity at these valuations, but there is leverage in the system as a result of that. So yes, he's smart to go do that when he knows he's expensive relative to the value of Bitcoin. But to your point, I get it. But I'm just saying, if you were to have a sustain, we've had an 8% draw down here in the last week or so, right? And it's nothing. I know it's not. I'm not calling it. I believe I'm not that person. But you get to 90 or 80,000, all of a sudden it can be, that type of situation. So let's talk about what's gone on in Washington, because the other theme, the original theme of Bitcoin, was that no government can touch it. It can't be regulated. Yet there's been a period of time where crypto people are craving regulation to a point, right? Up to a point. We want to be recognized. We want the ability to do ETFs, right? Clearing, and all that stuff that goes on that allows this market to function correctly. So talk about the Genius Act and some of the other stuff that has gone on. And then I want to get your thoughts on stablecoin, because it feels like Ethereum is going to play a bigger role in that world than Bitcoin potentially. And there I see that actually you can have a value, right, on the Ethereum. So talk to me about that.
Yeah. So, well, first of all, the regulation is key. We've had a lot of things that have happened that are tailwinds for Bitcoin in particular, but for all cryptocurrencies, but for Bitcoin in particular. Some of the things are the gap accounting rule. They changed the gap accounting rule where you can hold Bitcoin on your balance sheet, and it's no longer an impaired asset. So if it goes down in price, you don't have to mark it there and keep it there. You can actually, you market to market. That was a big deal, and that changed this past December. So that's a big deal. SAB 121, the accounting bulletin. This is important because of what we're talking about with stablecoins. But SAB 121 basically was it was an end zone run by the SEC to avoid oversight from Congress, and just to implement this rule by enforcement. And SAB 121 basically said, if you have a customer that has a cryptocurrency in their account, then you have to hold it on your balance sheet as a liability. So now that Trump is in office, they got rid of we have a new SEC commissioner. And so that they have issued SAB 122, Staff Accounting Bulletin 122, which abolishes 121. And so now banks can hold cryptocurrency and Bitcoin in particular on their balance sheet for customers without having to hold it as a liability. So really big deal. And that's why you're hearing of the banks working to offer this to their clients, to their customers. The JP Morgan just announced that they're doing something with Coinbase and a partnership with them. And you're going to be able to, integrate right into Coinbase and buy and sell cryptocurrencies right there with your JP Morgan account. It's a big deal. So what about the stable coins, the Genius Act? Why do we have this? Well, a little over a year ago, I was up in DC and we were making our rounds. We were talking to different senator and congressional aides and a couple of senators themselves about the importance of regulation and regulating this industry. It's happening. It's growing. The world is using it. It's not going away. We should get ahead of it. One of the things they brought up, Danny, was how important stablecoins were. And they realized how important stablecoins are. Why are they so important to the US government? They're important to the US government because stablecoins essentially are like a money market fund at these exchanges. And so what they do is you give them dollars or krona or euros or whatever it is, and they turn around and they take those and they put them into, typically, by and large, they put them into US treasuries. So they buy US treasuries with them, get a yield on that, and they don't give you that yield, they keep it. Typically, there's some sharing, there's some revenue sharing agreements that we can see. But if you're USDT, Tether, or USDC, which is the US-based coin, stable coin, which is Circle, they typically turn around and buy US treasuries. Well, Tether became one of the top 10 buyers of US treasuries last year. They're one of the largest holders of US treasuries now. They actually hold more treasuries than some G20s, which is it's incredible. It's insane. Well, why is that? Well, like I just said, there's a demand to have money that's accessible on these platforms. So you don't have a lag in the time that you're making a decision to buy something and you're having to wire money over or transfer money over from your Wells Fargo account or something, which can take days or weeks if they refuse to send it, which we've seen. Now you've got stablecoin, which is essentially as good as US dollars. It's pegged to the US dollar, and they use US treasuries to do that. That's important because it's not just because that money is just sitting out there and it's not in money markets anymore. Now it's over here in these exchanges. But it's also because the US government this all goes back to the government and excess spending. But the US government is spending so much money and running these multi-trillion-dollar deficits that they know they have to borrow more and more and more and more money, that they have to find new buyers of treasuries. They've got to continuously expand either wallet share or the number of wallets out there that are holding treasuries. How can they do that? Well, they can do it by getting anybody who is on these exchanges to buy these stable coins that are, whether they're whether they're Tether or Circle or sponsored by US banks. They're going to find new buyers of treasuries. There are a billion people out there who are unbanked. And what do they want? They don't want to own their home currency. They want US dollars. How do they get US dollars? Just buy a stable coin. If they have a phone and an internet connection, they can buy and they can get on there and exchange, whether it's Kraken or Coinbase or whatever it is, they can get on there and buy a stable coin. And the Treasury understands this. The government understands this. So instead of reeling and spending and doing responsible things in Congress, they're finding more buyers. And that's what they're doing with the Genius Act.
It feels like Ethereum in this regard, again, looking at it as a tech company, right? $425 billion is going to have value here based on I don't know if you say it's protocols. Is that fair? Layer 2, all this stuff. I have no idea.
It's the rails, right? So when you send Tether, you're sending on the Ethereum network. And so let me make something clear. My focus is Bitcoin. My greatest confidence is in Bitcoin. But I do believe there are a number of other protocols out there that will have value. I'm not saying that they won't. I'm sure there will. There will be a handful of our new Amazon, Apple, Nvidias, and Microsofts of the world. I don't know which ones. Ethereum certainly seems to be one that's not going away. I don't love the protocol because it's had problems, and you can't trust it won't be changed. It has been changed a number of times, but that doesn't mean it doesn't have value. Business plans get changed in individual companies all the time, and they still have value. So, but yeah, that's a good point. And so you're talking about the rails of how to actually move these stable coins around. Yeah.
So I want to go back to something that you mentioned, Tether. And I know you don't have to answer this. I know when I was looking at Tether, you were looking at Tether for the first time, and you knew that they did not have the collateral. There's no way that you were confident they had that collateral. Somehow over time, I think, have closed the gap. I mean, I don't have to go down memory lane here, but it's one of the things that turned me off at the time, kind of
It's the
Bitcoin.
main thing. It's the main thing that turned me off. Yeah.
Right.
It was not unaudited and unauditable. Right.
Right, exactly. So still questions out there, but that being said, it's easier now to see how it could be pegged correctly, that you might have that actual value in there. So did they just get lucky over time that happened? Because there was definitely some funky stuff happening at the time.
Yeah, I mean, it's the same thing with the U.S. dollar. The confidence in Tether is so great that even during the Sam Bankman-Fried fraud and the meltdown of some of those companies, when Tether did get unpegged for a minute, it went right back to where it was. And so there's that confidence that you're going to get that value out. So Tether is a very profitable company. They have a few hundred employees and they make billions of dollars. I mean, this is probably most profitable company per employee in the history of the world. I say that tongue in cheek, but it may even be true. But that's why, look, Circle is the gold standard for an audited stablecoin. And when we get stablecoins that are issued or sponsored by banks, it's going to be a similar thing. And so that's investing in. There's no way to invest in Tether. It's just you're using unless you actually invested in the company itself, which they're not raising money, so they got plenty of money.
So here you are in kind of early 2022. You're completely on board. You partner with David Foley, and you launch this Bitcoin Opportunity Fund. And literally, right in the teeth of it, Celsius gone, FTX happens, but you guys persevered, and so you got to see literally, I'm gonna say the end of the world of crypto, but you got to see the actual worst of the worst happen, and yet you made it through. So talk about your first fund, which I believe is you've closed it. Now you're running money. I think it started at $50 million. I'm sure it's higher than that now, not mistaken. Now you're raising fund two. You're long, you're short, you're private, you're public. So you guys I'm not telling you to give us your portfolio, but give us a quick background on that evolution, if you could, and then kind of where you guys sit today.
Yeah, it was it was the absolute worst time to start a fund. It was awful. However, it was a lot of opportunity. So there was just not a lot of confidence in the in the ecosystem anymore. That the confidence dropped out. So you're right. It was a bear market raise. You remember? Have you seen the bear? The show?
Yeah, of course. That's great. Love the bear.
So you remember in this may spoiler alert for anybody who hasn't seen it. You might want to mute this for a second. But there's that scene I think it's in the first season where they're the sous chef. She's walking down the street. And it's during COVID, and literally every single beautiful, incredible restaurant she walks by has a sign up that they're closed, they're shutting down. Thanks so much for all the years of service and all that. But she's walking down the street thinking, and she's headed to the grand opening of their restaurant. She's like, every one of these restaurants is closing down. What am I doing? That's what it felt like when we were opening the fund. Our target was 50 million. We've raised far less than that, unfortunately, but we did get to critical mass. We said, this is the number we're going to get to, and we can raise this, then we're going to do it. And David and I just buckled down, and we had actually, we've got some incredible limited partners who are not just investors, they're also in the space, and it's been great. So that fund is closed. It's done extremely well. We're up well over 100% now in that fund. But so Then we realized that the investors that were in that fund, the reason we closed it, Danny, is because it's a public-private partnership. We wanted to be able to invest anywhere in the space. And I've done this before in my last fund. It's complicated. It's layered accounting with investors coming in and out because you have to segregate out your private investments. Well, we didn't want to do that. We're just going to have one fund, open it up, close it, and so everybody gets a share of whatever we do in that fund. Well, then we started getting questions and calls from the current investors like, well, I want to invest more. Well, it's closed. You really can't. There's no way to do it. Well, and then we started getting more calls from people who want to invest in another fund. And so we eventually decided, okay, we're going to go ahead and open up a second fund, and we're going to make it evergreen, and we're not going to kill ourselves with marketing and doing roadshows around the world. We're just going to open it up and start collecting money. We've already eclipsed what we rounded up the first time. So, and that fund is doing exceedingly well because we started getting into these treasury companies really early. And we have an advantage being a hedge fund. It's kind of like back in the go-go days of the internet where you're buying Amazon from Goldman and Morgan Stanley. You're not buying them on the post IPO. You're buying them pre IPO. It's kind of the same thing where you're getting these things pre-market NAV, and you're getting them for like either one or closer to one or under one times the amount of Bitcoin they're going to own. So you're getting a discount on them. You're taking a risk, but it's calculated, and we know the managers that we are invested in, and we've not invested in every single one that have come. A lot have come to our plate, but we've only invested in a select few. But those have done exceedingly well as well. So, but we have the mandate is to invest in Bitcoin and Bitcoin adjacent companies. So it can be public, private, early stage, late stage, it doesn't matter. But our focus is really on more mature companies. We like to call it real companies with real revenues and real profits, because this space has so much speculation in it. And it's really, and we're unsure which direction it goes. We believe that the network grows, and we believe that there's definite use cases for it. And there's companies that should be built around it, insurance companies, lending products, that stuff. Those we understand very well. The Lightning Network and payment processing and all that, it's very difficult to know who's going to win out on that and how that's very early stage, pretty speculative stuff. So we've avoided most of that. All in all, though, what we do is we take capital. You can invest in either Bitcoin or US dollars, or actually we've taken foreign currency too, but we immediately take that and put it into Bitcoin. And so we're on a Bitcoin standard ourselves. So our treasury is actually in Bitcoin, which means that every single investment decision we make has to be weighed against the risk reward of Bitcoin at the time. So if Bitcoin's down around $19,000, $20,000, it was really difficult to get an investment in our portfolio, because we knew that Bitcoin was on a path to appreciate. We had a high confidence. We didn't know, but we had a high confidence it was going to appreciate quickly, and that would eclipse most of these early stage investments. And again, that's been kind of the challenge here. You've got this fast growing new technology, groundbreaking technology that's being adopted rapidly, but there's a lot of volatility in that. And so if you remember back in the early days of the internet, there's a lot of companies that just shut down because they just slapped up a www and didn't really have a real business plan. We see a lot of that going on, and so I think that there's a little bit of a mismatch in the life cycle of these early stage companies in an asset that's being adopted. That it's a little bit longer than that, 7 to 10 year, the venture capital kind of map and structure. So we've avoided that a little bit, and we've stayed focused on what's real in front of us and something that's pretty tangible.
And you do have the ability to go short. If there's a Bitcoin miner, let's say, that you think is really expensive, you do have the ability, and you guys have a great vantage point to do stuff like that, I would imagine.
Yeah, we do. We've done that. We've shorted some things. I won't talk about particular names, but but one of the things we can do, though, also is that because we're structured as a hedge fund, we can use non-Bitcoin type of hedges as well. We can use put spreads on the S&P or the NASDAQ on specific names. There's one situation last year or earlier this year, where the market had kind of gotten ahead of itself, and we expected a bit of a drawdown with all the tariff chatter. And there was one name, Apple, which hadn't really been affected much. And then we knew that Apple's the massive component of the S&P, and if S&P drew down, Apple would be a leader in that drawdown. And for whatever reason, the volatility was low and the price of insurance was very low. And so we used Apple instead. It's just specific names. We wouldn't get too big in it because there's specific name risk in being short any one name. But that's the kind of thing we can do where a typical fund like ours just can't do. So, but having experience in hedge funds for 30 plus years, David and I kind of work well together and play off each other and ideas like that. So that was his idea, and it worked out really well. So
yeah, it's great to bring that element into the fund. So people can find you at jameslavish.com. You also write the informational list on Substack. You're a great writer, by the way. Read some of the stuff. So easy to understand.
My wife's an author. She taught me.
There you go. There you go. So they can find you there. And so, James, thank you so much for coming on the tape. Would love to have you back again. I know you and I have been on podcasts together in the past, but I think we've diverged a little bit. But maybe I'll move from a Bitcoin mini, to somewhere down in the middle. I don't think I'll be a Maxi. I don't know if a mini is even a thing, but I just labeled myself a Bitcoin mini. But I'm going to come up the curve here. But you should be very scared if you ever hear me go all in on Bitcoin. I'm telling you right now. You call Foley in the middle of the night and you sell everything, okay?
Well, you should become a Bitcoin solid. That'd be good.
Yeah.
All
James, thanks for coming on the pod. Really.
Thanks for having me, Danny. I look forward to the next time.